In this week's update, AI trades take another broadside. What comes next? Markets led by resources and a huge silver breakout. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, a bit of a shorter video this week. The only real notable event came on Friday in the US, so we'll feel the effects of that a little bit in our market next week. But the US market, and to a lesser degree, the Australian market, were going along very, very nicely until Friday night in the US. And we saw a couple of company-specific announcements in the last couple of days that led to that sharp sell-off in AI stocks and semiconductor stocks. The first one was Broadcom, that announced that they were experiencing some tighter margins and the order backlog was falling short. Or this is not what they announced, but certainly this is what the market deduced, that the order backlog was falling short of what they expected. I think the market expectations are incredibly high. They just want to see those numbers keep going up and up. But to be honest, a stock like Broadcom had run a great distance and really was due for a bit of consolidation. So I don't see anything too dramatic in that. And Oracle also pushed out their data center completions from 2027 to 2028. This is a market that's still a bit nervous. It's still going to rotate away from technology into other sectors at the drop of a hat. And those couple of bits of information were enough to push that rotation again on Friday. But look, for the week as a whole, global equity funds saw the largest inflows in 5 weeks. So this remains a rotation. It's not an exit from the market. It's money moving from one sector to another. And that's normal. That's healthy, because sectors get overheated, because too much expectation is built in, and then it rotates into other areas of the market. And that's pretty much all that's happening. So the selling, from my perspective, although it looks a bit nasty, it's only one day. It's likely to be transient at this stage, and it's mostly going to be impacting AI stocks and semiconductor stocks. So that's how the week finished off. On Friday night, there were plenty of 6% to 12% falls. So as always, looking at the indices doesn't give you any sort of colour or flavour to what's happening underneath. You got to look at a couple of hundred individual stock charts. So there were plenty of sharp falls, but it was very specific to the sector. And it was also lacking volume conviction. There was a couple of stocks where the volumes were higher. But as a general statement, the volumes were about normal or even a bit less than normal. And it's this time of year where liquidity is drying up. So nothing too much to be concerned about at this stage, because there were certainly gains in non-tech areas. And as we'll see, resources are absolutely sprinting at the moment, and I covered this in some detail last week. Now, as always, advisable for you to get whatever advice you need before starting the investment process. All right, American stocks now for the week. The S&P ended up down 0.65 and the NASDAQ by 1.6. All of that pretty much occurred on Friday night in one session. The Russell 2000 ended up rising for the week, and also the RSP, which is the equal weight S&P index, also rose. So the S&P was down, but if you take away the effect of the very large mega cap stocks, then the rest of the market was going along quite nicely. The US dollar index was down a little bit, 98.39. The 10-year yield rose slightly from 4.14 the week before, but I think this is also telling. The VIX hardly moved on Friday night despite the selling in semiconductor stocks. So I think that sends a message itself. All right, let's look at the charts now. This is the NASDAQ composite on a weekly chart. You can see we pretty much just gave back what was gained last week. So nothing overly dramatic. But when you zero in on a daily chart, you can see a little bit more color to what happened. And if you go to the semiconductor index, this is semiconductors on a weekly chart. So it was down for the week after forming a double top. So this could be some technical influence in here as well. But if you look at the daily, you can see what an abrupt reversal it was. Everything was just ticking along nicely until Friday night came along. And I'm always wary of announcement-driven moves in the market, particularly when they're against the trend, they tend to be fairly short-term. And I don't see any reason at this stage to think this is going to be anything different from that. Now, let's look at the relative comparison where the money flows were going on a sector basis in the US. And this is over the last quarter. So we've got healthcare has certainly picked up very nicely. XLK over the last quarter, obviously falling off a cliff starting late November. So this has been about 3 weeks now. And it's come down very sharply from leading the market to starting to get back into the pack. And they were the only two which were above the S&P over the last quarter. But you can see there certainly are some areas of the market that are turning up just of late. One of them is finance, and also we've got materials as well. Now you can see that more clearly when we zero in on a monthly basis. This chart is very messy, but it tells the important factor, and that's XLK, which is the technology sector, is now dropping like a stone, and it's the worst of the sectors. But materials is rising very, very quickly. So they're the two notable points. And if we come in to the last fortnight, it's even more obvious. So we've got finance at the top, we've got industrials, XLK falling apart, and materials doing quite well over the last little period. If we look at the S&P, this is again a weekly chart. Didn't quite give back what it gained the previous week, but there's nothing particularly nasty in that chart. And there's the RSP, the equal weight, breaking out to a new all-time high, and the same thing with the Russell as well. Now, I'll just touch on the Australian market. So the Australian market over the last quarter, materials have clearly been the outstanding sector, followed by the small caps, XSO, and then we've got energy, and then the ASX 200. So they're the only three sectors above the ASX 200, and everything else is below over the last quarter. Let's narrow this in a little, look at the last month. And again, nothing's changing here. Materials really separating itself from the rest of the pack. Getting a bit of a rebound in healthcare, but that's really just from grossly oversold. And of course, at the bottom, we've got information technology, which has just been absolutely slaughtered in Australia compared to what's been happening in America. And this is the last fortnight. So you can see it just graphically demonstrates the rotation in money in the Australian market. So that's where we sit with the Australian market at the moment. So Aussie stocks, the Aussie dollar was at 65.87, so it gained a little bit. There certainly are some forces that are pushing it higher. We've got the US dollar in long-term downtrend, and we've got strength in commodities, and the Australian dollar is always associated with commodity strength. So our dollar is always going to do well in that sort of environment. We've also seen an abrupt shift in the expectations around bond yields, particularly in Australia, and we've gone from a rate cut expectation a few months ago in Australia to the almost overwhelming expectation now of a rate hike, possibly as early as February. Our market was up 0.7% for the week, but I guess that will change on Monday. And materials and small caps, clearly the leaders. Now, I want to just go and look at some of the individual areas of the Australian market. So this is the ASX 200 on a weekly chart, so you can see quite a good week. So this is materials on a weekly chart, so that is breaking out to new all-time highs. So no question the materials sector is doing well, and particularly in the smaller cap space as well. There are just some meteoric performances at the moment. This is the information technology sector, again on a weekly chart, and it's falling very, very sharply over the last 6 or 7 weeks. Healthcare, and the key thing to note here is where the direction of the 200-day moving average. So in the case of information technology, it's still heading higher, and the price or the index value for that sector is still above that rising 200-day moving average, but it'll want to find a base and turn around pretty quickly. Healthcare clearly has rolled over and is also below the 200-day moving average. All of the shorter-term moving averages are pointing down. So this is in downtrend. Finance, it's pretty obvious what's still happening with finance. It's still a well-supported area of the market, still rising. Energy, we're flat on the 200-day moving average, but we're below. Now, we've had a recovery from an absolute smashing, but we're still below. So there is still no positive momentum in the energy sector. But this is the one that I'm really excited about, and we've been doing plenty of during 2025, and that's the Emerging Companies Index. Now, this is not just resource companies. This is other parts of the economy as well. But you can see all the moving averages are all lined up as you would want them to be. And the value of that index is leading the way, and leading the way very, very strongly. So we had a retracement for a few weeks, but it would appear that we're off again. So if you want to do well in the market in the short to medium term, then you've got to stay with the momentum. And this is clearly where the momentum is. Just checking on currencies now. This is the US dollar index. So it's down for the week. And the Australian dollar index was up for the week, pretty much as you would expect. Right, turning now to precious metals. Gold was up by $99 for the week to almost 4,300. Translate that to Aussie dollars, 64.60. Silver, this was the really big mover, up 6.7% to 62.01. That was well off its highs, which were above 64 at one stage. Bit of a reversal on Friday. And according to the World Gold Council, for gold, this is the strongest annual return since 1971. So we really are in a very powerful bull market in gold. And the gold and silver ratio has dropped below 70 for the first time in 5 years. So that is a real solid indicator of where the money is flowing. It's flowing preferentially into the silver market, which is what you'd expect. And it always happens in very significant bull markets in precious metals. Gold will be outperforming silver in the early stages and then towards perhaps the latter stages. But bear in mind, we're talking yearly kind of timeframes here. The silver value starts to pick up dramatically relative to gold, and that's certainly what's happening. So they're both going up, but silver's going up far more quickly. Now, if we look at gold stocks, the consolidation that I pointed to last week and the week before seems to be pretty short-lived. So let's go and have a look at those parts of the market. We'll start with silver. This is a weekly chart, and that's a huge week for silver. Very, very strong breakout. It actually peaked at 63.57, but the futures were above 64 late in the week. So you can see that's a clear breakout into new territory. So silver going very, very strongly. It was only really Friday that we got a bit of a reversal in the fortunes of silver, but that would appear to be very temporary. There's no question the momentum here is very much to the upside. This is gold in US dollars on a weekly chart. Basically, this was the highest closing price in gold that we've seen. So that hits a new closing record. And the Aussie dollar doing slightly worse because the Australian dollar appreciated during that period. Now let's go and look at the actual gold stock indices. So first of all, GDX, which is the Aussie listed index. You can see very, very strong week. So here was our consolidation over the last 5 or 6 weeks, but it would appear now that we're heading back up to new all-time highs in GDX. And this is GDXJ, which is the US listed index, and the same process is happening there. The momentum is definitely in precious metals along with some other resources as well. And speaking of which, other commodities, copper was at $5.28, I think was trading almost to $5.50 at one stage. Goldman Sachs have got a forecast of $5.80 by Q2 next year, which they believe is the incentive price required to meet the needs of the energy transition. So that's Goldman Sachs. Citigroup Agreed. So we've got this constant battle between the depleting reserves that investment over the last decade has been completely inadequate to offset the depleting reserves of the major mines around the world. Forget about the rising demand. They can't even keep pace with the demand if it stayed static. So we really are looking at a very, very bullish decade ahead for copper. And crude oil dropped back to 57.44, and really what we've got, this isn't short-term price signals from the crude oil market. We've really got a commodity that's under long-term structural pressure. There's just excess supply. So I don't see any joy in that crude sector at all. There's the spot copper chart. So we're starting to get back to that peak that we saw earlier in the year associated with the potential tariffs on copper. So that's quite a strong uptrend. Thought we'd also start looking at antimony as well. There's a real structural deficit here for antimony that's going to continue for a long period of time. And antimony, whilst it might be a very unfamiliar commodity to a lot of investors, it's got vital strategic uses in defence and also in batteries. And then on top of that, you've got China export restrictions add further pressure to that deficit balance. And to illustrate, there's the antimony price going back to 2006. So it's the last 20 years. You can see it's really taken off. It's gone up by about 4.5 times over the last year or so. So that is why there is so much interest in the antimony, because it's not only a critical metal, it's also in a structurally deficit position for a long period of time. There's lithium carbonate price, and I've been observing this and commenting on this for quite some time, since earlier this year when lithium stocks started to recover. My concern was always that there was a lot of production that could be switched back on very quickly from all of what happened in 2021, 22. So that looks incredibly bullish. And I guess within the period of the last quarter, it is incredibly bullish. But let's just keep things in perspective, because let's go back and look at the last 5 years. That really does put the lithium carbonate price gains into perspective. So I'm still, to a degree, cautious. I can't be anything other than more positive than I was 6 months ago. But I'm still concerned from a fundamental point of view that the price will get to a level where a lot of the currently shuttered production is switched back on. So it's not one that I'm prepared to go boots and all in at this point in time. So the final message, wrapping it all up, you should have started making diversification moves to accommodate the rotation that's happening, and that should have been underway weeks and weeks ago, because I've been talking about this throughout that time. You've got to go where the momentum is, and very clearly from all the charts that you've seen, the momentum is into small caps, and it's particularly into small cap resources. So it's precious and critical metals, it's copper, and it's select industrials as well. So there's some really good cutting edge industrial stocks that are doing very, very well. Last week, Portfolio Analyst, we looked at gold producers and gold developers and highlighted a few notable stocks. So that's it for this week. There's more information on the website, and there's my email address, and I'll be back with you next Sunday, possibly for the final video for the year. So I'll be back with you then. Cheers.